VCs was a secret thing. Like you couldn't even get a meeting. Like it was like all about proximity. And then the internet distributed that around the world. So now smart founders all over the world can build great stuff, no problem. And they can get access to all that information and the technology, and they use AWS. And I was like, oh, it's going to globally distribute. And then AI brought it all back.
Hey guys, welcome to VNTR Podcast, and today we are hosting Zach Coelius. And welcome, Zach. Maybe you can briefly introduce yourself.
How's it going? Good to see you. Yeah, my name is Zach Coelius. I'm an early stage software investor based in San Francisco. I've been doing this for about 10 years. And then before that, spent 20 years as an entrepreneur, 4-time founder. So I like to say I'm a washed up entrepreneur, but I washed up on the beach that is being a douchebag VC. And I've never left. It's a lot easier here than being out in the storms fighting as a founder.
Nice. Could you share a little bit about your journey as an entrepreneur? What did you build? What were the most successful things you have done?
Yeah, so I started my first business when I was 16 at the Olympics. Ended up running that at like 4 different Olympics. By the end, we had 13 people working with us. So it was like a great cash business, a great way to get to go to a lot of Olympics, and it was like super fun. The first online voter registration and absentee ballot solution, so tools to help people vote over the internet, back when I was in undergrad in college, which was a fun journey. And then an offline business. And then my biggest sort of business, we started what became a competitor to Trade Desk, which is now a $50 billion something public company. We were an online advertising platform for buying media. And that was a 10-year journey. Started that when I was a kid, effectively in 2005. And then we sold that in 2015. So it was like a crazy journey. And then that's when I shifted to this side of the business.
And is it when you started investing in 2015, or you did invest while being a founder?
No, I had been advising and helping, but I didn't have any cash to make any investments, which is unfortunate because I was there at the beginning of Uber, Airbnb, Dropbox. I mean, I was like literally the poker table that I would play at was all those founders were at that table. One of my friends, we were at a bar one night, and one of my friends was starting a company, and he was like, "Yeah, we got this cool company. It's like you push a button and you get a car." And we were like, "Whoa, that's cool." And he's like, "Yeah, I'll give you free black car rides for life if you invest $5,000." And one of my buddies is like, "Oh, I bet you I get $5,000 worth of free black car rides out of this before you go out of business." Okay, cool, I'll do that deal. Yeah, he made 20 his Uber investment. So yeah, no, I was not investing. First investment I made, I just sold the company, and AngelList had just started. The Syndicate product had just come out, and the way that works is that you find an investment, you write the memo, you put it up on AngelList, and then people can choose to opt in to participate in the investment or not. And so one of my companies that I've been advising is this company called Branch Metrics. They do mobile deep linking. Since has become a unicorn, but at the time, I was just getting started. I'd introduced them to their seed investors. Series A was happening, NEA was leading, and I was like, "Hey guys, can I try this new angel listing?" And they were like, "Sure, knock yourself out." This is like January 15, and so I wrote the memo, put it up on AngelList, sent it out, email out to all my friends, and like 24 hours later, I'd raised like 200K. I'm like, "Wow, look at that! I'm an investor now." Like, no idea what I was doing. And then got lucky. The next deal I did was Cruise. So a year later, there was a $1 billion exit, and everyone thought I knew what I was doing. And I mean, at the end of the day, like any idiot with a checkbook in Silicon Valley for about 10 years looked like a genius. Everything went up. It was like 50% IRR every year, 50% up. Like it was so easy for about a decade. Yeah, so I got lucky.
And then that ended, right? That rising tide ended at some point.
Oh yeah. What we didn't realize, none of us really realized, is that like we looked at the technology swings and said, okay, it's all about technology cycles. So, cloud, mobile, SaaS, major technology cycles. We're like, look how smart we are. We are identifying the cycles. We're investing in the cycles. We're in front of the curve. Look how smart we are. And really, the zero interest rate environment where you didn't make money investing anywhere else caused that cash to flow into Silicon Valley at a dramatic rate. And because Silicon Valley startups are they're not liquid investments. You don't have the ability to short them. There's not a counteracting function to basically bring rationality to the market. And so it creates this incredible momentum in the sort of private asset market. And that momentum just builds on itself. And so you invest in a startup, at a $5 million valuation. They're just getting started. They go out and they raise money a year later at a $30 million valuation. Yay, you're a genius. And then the next investor shows up and their job is to invest in the next round, and they invest at a $100 million valuation a year later. And boom, you're looking at a huge gain. The thing is that gain then gets sent back to the LPs. The LPs on paper, the LPs see it, they tell their friends, and then those guys pile in, and then that increased capital just leads to more and more and more and more markups.
So network effect.
Yeah, and that creates the perception of success. And so the zero interest rate environment meant you couldn't put your capital anywhere else. And then the capital in Silicon Valley, all these markups just made, by the end of it, it was like in 2020, 2021, and 2020, by the end of 2021, you'd see a company, I'd invest in it, early, you get to $1 million in revenue in the first year because you had mobile, you had SaaS, you had all these things to really get them going. And then some VC firm would show up and they'd be like, okay, we'll do 20 on 100 for $1 million in revenue. So now you're doing 100 times revenue, not 100 times earnings, 100 times revenue for these early stage companies. And, we look like geniuses. Look how smart we are. And then it's just like the feedback loop is crazy.
And that's obviously the market's changed a lot. We had COVID and AI and other crazy stuff going on in the world. But it's interesting to hear you, because you've almost been around for exactly 10 years. So kind of how have you matured your thesis during that time? Because you said you started off, you didn't know what you were doing. So what would you kind of tell yourself in those early days?
So it's like everything in venture. There's a yin and a yang to this. On one hand, everything has changed, right? So I've now invested in 80, 90 companies. We've sold 15 of them. We've got a handful of unicorns. The companies generate over 2 billion in revenue across the portfolio. So I've gotten to see a lot of things, a lot of reps. And then before that, all those years as a founder, so I've learned a lot. And that makes me much more sophisticated in the questions that I ask founders and how I think about all of the different components of building a business. So, really getting into the nitty gritty of go to market, really getting into the nitty gritty of product strategy, really understanding platform risk and technical sort of especially on these AI, for a lot of AI application layer companies, there's a lot of significant risk in sitting on top of these foundational models. You can go down these rabbit holes, and you can because you have a lot of experience now, so I can get really deep into all the nitty gritties. On the other hand, and this sort of the yin and yang of it, you also kind of realize that at the end of the day, it's all just about people. And people are not about rabbit holes. They're not about nitty gritty. It's about evaluating these very ephemeral but very important personality traits, trying to feel in this very sort of touchy-feely way who this person is. Because you now, having spent a decade watching it, I've watched these founders, and the personalities matter. At the end of the day, when the chips are on the table and you make these really hard decisions, the personalities really matter.
So what are the personality traits that you identified? Is there a pattern?
Yeah. I think all the things that they tell you to look for, so driven, smart, ambitious, those things are all good. The one that YC focuses on, which is grit, is a really powerful one. I think that one gets underestimated. I've watched it now in this part of the cycle where, for all those years when we all looked like geniuses, I only had 2 out of 80 companies go out of business in all those years. like, woo, look how smart I am. And then now over the last few years, it was like we lined them up against the wall and started shooting at them. And like a lot of them have gone down because capital has become so sparse. And watching the decisions that some of them are making and some of them are not making is really exemplified to me how the founders who survive through a cycle like this need to be the ones that are really, they're just gritty people. And there's lots of ways you can test for that and sort of questions that you ask and sort of how you like identify the personality type. But like, you know, they're the sort of person where we show up in a city for a meeting, the hotel is overbooked, and they literally open up their phone and they're like, oh, there's a hostel across the street. Let's go across the street. And like they were staying in a 5-star hotel and they go into a boarding room, hostel, bunk room, and they don't care. They're like happy with that. Those are the people that are winning right now. Whereas the people who are like, but my hotel, and they get mad at the front desk, those people are dying right now. You're seeing that. And any startup to be successful, it's a 10-year journey. Like, and so as a result, you're going to go through a cycle like this. You're like every startup is going to go through the cycle. And so if they're great in the good times, but they die in the bad times, you don't make any money. So you need people who can survive.
Like, would you invest in repeat founders?
I love repeat founders. They need to be a little twisted because like once you do this job and realize how fucking hard it is, you you don't really want to do it again. Like I said, I washed the beach that is being a VC, and I'm like, this job is way easier. I'm not doing that. To go back into the maelstrom and fight through the brutality of being a founder, it takes somebody special and weird and a little twisted. But those people, oh my God, they know so much and they handle these situations so well, and they're really good. Like I have a couple of repeat founders in the portfolio right now that are going through absolute hell, and they make it look so easy. Like, I mean, they're getting crushed by the market, by all these different things, and they just handle it like professionals. And I'm like, I like those people. People are good.
How do you support them in these situations?
You know, I have the model. So I'm a solo GP. It's just me. I don't try not to sit on board seats. Every now and then I have to take them, but I don't want to. And I basically I have a model of like, you let me know when you need help, like, and I will be there. Now I'm only good for a few things. Like I'm not going to be able to go through your financials and like identify the cell that's off. Like I'm pretty good with fundraising. I do a lot of work with fundraising. PR, I do a lot of work with PR and marketing. Positioning, I do a lot of stuff there. My network is large, so I've been doing this for a long time. I know a lot of people, so I'm good at connecting people to other people. You know, things where I can add a lot of leveraged value with a relatively small amount of time, because I don't have a shitload of extra time. That's where I try to be useful.
And obviously, AI is the topic of the last few years. So maybe we can ask a bit more of a kind of technical question. I mean, you talked about SaaS and particularly B2B SaaS that you invest in. So our question for some of our viewers is, you know, how are they responding to AI? Because we're having these like super sharp AI vertical kind of softwares coming in that kind of counteract the broad systematized SaaS that already exists. So kind of what's the best approach there, in your opinion?
So far, AI is living up to the hype in terms of the performance for my companies. So both my existing companies and then my new companies, you know, it's always tricky with these hype cycles in that like everybody gets excited and everybody's like, oh, the future is crypto DAS or whatever, and then 6 months later they forget about it, they move on to something else. You always got to be careful in these hype cycles because it's easy to get caught up in the craziness. So far, the performance has been really good, and companies are overachieving what we thought in a lot of ways. In answer to your question, the interesting thing about it is that because of the way that the foundational models work, every company can adopt the technologies. And so what we're seeing is it's the more mature companies that are already established, that already have customers, that already have really, really good distribution, are able to, if they're smart and they're agile, they're able to adopt SaaS AI tools, and they're able to transition. And so, like, for instance, one of my best companies, or a really good company, is this company called Shortcut. It used to be called Clubhouse. What Shortcut does is it's basically like a better version of Jira. So if you're tracking bugs for your engineering team and you're tracking all the things that the engineering teams need to do, they do a better job. It's great. Good company. They've grown quite large, well established. They're good. AI comes out and they're like, oh shit, how's this going to work? And for some companies, they kind of put their head in their sand. They're like, well, I don't know. But for the best founders, they basically are like, oh, I got to go back to basics. I got to rethink my business. I got to rethink my product, and I got to redesign from the bottom up using AI. How's AI going to enable me to do this? And a lot of them took their time doing that. They were smart and thoughtful and really thought about what AI could do. They did a lot of iteration and testing internally. And those guys have built this amazing new AI product that is just like super powerful. And now they already have all these customers. They already have all these salespeople. They already have all these marketing people. They have all these tools to basically bring it to market. Whereas a startup that did the same thing, they don't have any of those tools. And they don't have any of the customers to iterate with. They don't have any experience. And so I think a lot of the most successful companies in AI are in the application layer are the companies that are small enough to still be agile. They're small enough to basically still like move quickly, whereas like the big companies can and do struggle with that. But they're established enough that they've got the people, the teams, the customers, all the things that enable them to basically go out and move rapidly once they find it. So yeah, it's an interesting progression in the SaaS market as a result.
So it sounds like more established guys that adapt, they are the winners. So is there a way to, like, do you see new incumbents in SaaS with AI proposition compete well with the existing market players?
Yeah, so I would say it's not all of the situations are like that, the existing players, because there's lots of examples of brand new companies that are crushing it in AI. Like I have a company in Lithuania called Sintra. They do AI for SMBs, and they're just like blowing it out of the park. Like just doing really, really well. Yeah, brand new, fresh company, fresh idea. They're doing something that there wasn't a SaaS tool to do before, so like that they could start fresh. And
how did you meet these guys from Lithuania?
I was introduced through another VC firm in Poland who got to know them, and they were like they wanted some Silicon Valley investors to help out when the next fundraise occurred, and I do that a lot. I kind of act as a bridge between, because I spend a lot of time in Europe, and I act as a bridge between European startups and Silicon Valley VCs, and sort of like make connections and introductions and stuff. This one was fun because like they're doing so well. I introduced them to Benchmark and Greylock and Andreessen and all these people, and literally I have never seen those guys move faster. Like the Benchmark partner, the Sequoia team, literally was on the plane there the next day. Like it was like to Lithuania. Like it was just like whoa. The Benchmark partner was like the next like I was like whoa, moving fast. So when a company's doing well these days in AI, oh man, it's fun to see.
Definitely seen ads for Sintra on my feeds.
Oh,
it's
yeah,
like
that's what they do.
cute agents, right?
Yeah, they do SMB agents. So they'll have an agent that will help you with your social media marketing and your SEO and your accounting and your sales, and they're doing really well. But to go back to your original question, the great thing is that we took the whole board. We had this SaaS board that was well built out, this monopoly board, and everyone thought they knew where they were, and everyone thought they knew who had Park Place and who had Boardwalk and who was winning the monopoly board of SaaS. We'd spent 20 years building that board, and we were taking it, we had thrown it up in the air, and like who the hell knows how it's going to play out. Like everything is up for grabs now. And maybe it's Salesforce. Salesforce acquired one of my companies called Apprente, which is an AI for voice agents. And like you look at what they're doing, and they have all this distribution and all these marketers, and they're like, they're well established. Okay, they're going to go figure it out and win. Maybe it's all these little baby startups that just like shoot up. No one knows. It's the best part.
So I think the next question is around product market fit, and that's obviously like the holy grail of founders. What's the signal? Like, when do you know Because it's not just about money, right? It's not just about taking revenue. So when do you know you've got product market fit?
So what I tell people is the secret to product market fit is about the crystallization of value that you can articulate very cleanly. And so what you find is that when you go talk to a founder in the beginning, you're like, what do you guys do? And the founder would be like, well, we do this and 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 they're kind of like they're throwing all these different features and functionalities at you to figure out which ones you get excited about. When you find product market fit, what I like to say is you can cold call somebody at 9 o'clock at night on their cell phone while they're putting their kid to bed, which is like the most horrible time ever to call. Fuck you, why are you calling me? Describe what you do in one sentence, and instead of that person hanging up the phone, they're like, I actually want to talk to you tomorrow. And it turns out that happens a lot. So like when we had Trigget, my last company, we were competing with Trade Desk and a bunch of other companies that were in that space. There were 6 of us who were all kind of in the DSP space, which was the space that we were in. And we were getting our ass kicked. Like we were just like, I was like a young kid, didn't know what I was doing. And like I was in the back of the pack. And so we had to fight for years to get to like $1 million in revenue. It was so freaking hard. And we were the worst of the bunch. And so we were just getting slaughtered in that market. And then right before the Q4 earnings, before Facebook went public, they missed their earnings. They missed their earnings because their ad platform was garbage and they had not built it correctly. And Zuck went to the Facebook ads team and he was like, what should we do? And they were like, well, maybe we should let these little startups who know how to basically monetize our ads, maybe we should let them buy our ad inventory and use their technology and to make them work better. We're going to let in the outsiders into the Facebook platform. And we were one of the companies that they let in. And we identified that the thing that works in online marketing at the time, one of the things, was this thing called dynamic creative retargeting. So what that means is when you go to booking.com and you look for a hotel on Booking in Sao Paulo, April 5th to April 9th, we show you an ad for that hotel with a price, and people click on that stuff all day long. You go look at a pair of red Nike shoes, we show you an ad for red Nike shoes, people click on all day. So we knew that because we'd been doing this for a long time. So we were like, great, let's do that. And Facebook let us do that. And they had never existed before on Facebook. And so now we call up all these big marketers. And before we would call them and they would hang up the phone. But now we'd be like, hey, dynamic, creative, retargeting on Facebook. Full stop. That's it. They were like, send me the contract. We went from $1 million in revenue to $30 million in revenue in 12 months. And we had $300 million in revenue on the books before. If Facebook hadn't have fucked us, we would have been like we were just on fire. One morning we come to our office. It's like, we're a startup. So like we get there like 9, like maybe a little hungover. And there's a dude in a suit standing outside our door. And this is like in the middle of San Francisco in a bad neighborhood, like Mission and 11th Street, which is not a great spot. Like there's heroin addicts who would hang out outside of our house, our apartment, our office. There's a dude in a suit. He's standing there on the street. He's like, fucking took you guys so long. And we're like, who are you? And he's like, I'm from XYZ big company. I'm in town. I want to work with you today. I'm signing the contract today. And we were like, did we have a meeting with you? He's like, no, I'm in town. I just showed up. I'm here. Let's go. We were like, whoa, that's product market fit. And the thing is that like, you can spend all this time with the ands. We do this and this and this and this. And then you find the thing the customers really want. And that's it. It's all over. It's just like, that's what it's all about. It's like, what's the thing that they really want? And it's usually like one thing. It's like, it's not like, oh, here's this complicated platform that does all this shit. Nah, it's like one thing.
It's almost like people talk about making everything smooth and seamless, but in this case, you want to kind of test whether customers will jump over that little hurdle to buy it, and that's quite an interesting test, actually.
Yeah, so like you have to remember part of my bias. There's a lot of different investors out there in the world, and there's some investors who are really good at like the design and the seamlessness and the smoothness and the pixels and the edges and all that stuff. And my bias is towards not that. My bias is towards the articulation of that one little thing that's super valuable. That's what I look for. And that doesn't mean that they're wrong. I'm sure there's great investors who've done great work in that market, but that's not what I get into. I get into this idea of like, what's the value?
So the best deal flow comes from introductions in your case, or you go to demo days. Like, what is the best way for you to source deal flow where you actually deploy?
Yeah, it's all from my friends. So my network, people send me stuff, and then I just look at it and like every day it comes in, and every day you just kind of be responsive. Like it's the demo. The problem with demo day is like you go to a YC demo day, and it's like 1,000 investors in the room now. It used to be much smaller, but now it's 1,000 investors in the room. And you ask yourself, you're like, okay, am I the smartest person in the room about this subject, whatever it is? Space launch company, no. Deep tech company, no. Biotech company, no. Okay, ad tech company. Okay, yeah. There's very few people at the YC demo days who are smarter than I am in ad tech. Like there's some other smart people, but there's not many. Um, Oh, some idiot from Abu Dhabi marks it up 30 times what it's worth, and like now it's like basically like they're 40 pre for two founders and an idea, and that happens all the time. And so the adverse selection in these demo days is so bad that like it's just very difficult in a demo day to like find a great company that doesn't have dumb money marking it up too high or making it happen too fast or some other thing about it. That it's hard. It happens. People have done very well at demo days. People YC is great. I go to every one, but like it's hard.
Yeah, so you mentioned you travel a lot. How do you maintain that network, right? It's kind of in order to get referrals, um, how do you stay in touch with them?
So I spam on the internet a lot. Like I write a lot of tweets and LinkedIn things, and like I push out content a lot. Every month I host two dinners in San Francisco. Last night we did founders, so we had 40 founders there, and the night before we did VCs, so we have 40 VCs. And then it just like I have a big list. So like if you guys want to be on the list, you're welcome to get on the list. If you ever get to San Francisco, there's like literally thousands of people on that list, and people just come whenever they want to. It's very informal, but like every month, and we've been doing that for 7 years now. It's a good way to stay top of mind.
Where do you host it?
In a restaurant in the Castro in San Francisco.
Okay.
Yeah, and people from all over the world, when they come to San Francisco, if they're in town for it, they come. It's a good community that we built there. I go to a lot of events, so like tonight I'm going to go to a couple different events. I speak at a lot of conferences. Like I would say, at least 30% of my job is just networking, like being in the market.
Are you planning to attend Web Summit this year?
Yeah. I've been going to every Web Summit for a long time. I'm going to the Vancouver Web Summit. I'm speaking there in a couple weeks, 3 weeks, whatever,
Nice.
whenever the hell that is. And then I'll be there in Lisbon for sure. Yeah.
Yeah, you should attend our VNTR Summit on November 11th. So we will be there as well.
Oh, cool.
Have you got any? So we were speaking about networking before, and as a VC, I imagine you get a lot of, I guess, attention or founders trying to talk to you and try and pitch you and stuff. Must be quite overwhelming. Have you got any advice for founders who want to reach out to you or any VC in that aspect?
Yeah. So I'm a solo GP. It's just me. Not and time is always the issue. So I tend to be pretty aggressive about not taking those meetings unless they make sense. And so for founders, the way I do it is if I know the founder, it's different. Like if I have a relationship with them and like we go way back. But like for people who I don't know, I look at the deck, and 99% of the time, I'm not smart in the category. So like if you're trying to raise money for something I'm not smart in, I'm not going to waste my time. And that's just the way it works. But if it's a space I'm smart in or I'm interested in, then I love talking to great founders. And so like I tell them I have a user manual that I put on my LinkedIn, and it's literally this is how I do what I do, and like just do that. So like send me a deck, and then if it's in my area of expertise, zone of competence, I would love to talk to them. And then we get on a quick Zoom and we chat, and it makes sense or it doesn't. 99% of the time, it's not. And so the great thing about the raising money in this new model is that it's so much more efficient for the founders. The founders can email 100 people like me, and then they can find a few of us who are interested in the space, and then they can get us to engage. But for me, it all starts with the deck, because that really enables me to look for that crystallization of the value proposition. And I can parse through a deck very rapidly, and I do that all day long.
Do you use any AI tools for that as a solo GP?
No, no. I'm skeptical of AI's ability to identify or come up with new ideas. Like at the end of the day, if a human knew as much as AI does, it would have generated a lot more new ideas than AI has generated for us so far. I haven't heard of anything yet where I'm like, AI came up with this new idea that's amazing and is changing the world.
Yeah, I meant more using AI tools to manage yourself as a solo GP. What is your toolkit?
I'm like a kind of like a grouchy old man when it comes to my tools, and I'm a late adopter for these things. So like I use AI foundational models every day to talk to and ask questions and learn stuff. But like I have not found tools like of all the Silicon Valley VCs, I'm like the worst when it comes to like identifying and adopting new tools. Just like I'm just not fast at that. I let all my friends go be the guinea pigs for that, and then they're so good at it. I mean, it's so fun. You go to the YC demo day, and there's all these like people talking about their tools, and like I mean, they're playing with tools that aren't even released yet, and they're like, "Oh, I love this, I love it," and they're like, and they get to figure out, they get to go through all the pain and agony of all the broken features and like all the iterations and all the time you spend getting up to speed. I let them do that, and then when they figure it out, they let me know.
And obviously, angel-less syndicates, very different process to just traditional VC.
Yeah.
What are the kind of the differences and benefits of an angel-less syndicate like yours over, you mentioned Andreessen, for example, before?
Yeah, so my capital base is I'm on both sides of that. So the current capital base is about 100 million in aggregate. My main fund, traditional VC fund, is a $33 million, like 60 LPs, all the normal standardness of it. And then I have an opportunity fund, and then a rolling fund on AngelList, and then the syndicate. And so across that capital base, I can draw from any of those four different pools of capital, depending on what stage the company's at. So the fund does all my early stage stuff, the two funds, the rolling fund and the main fund. So any early stage deal I do under $100 million valuation, it comes from the rolling fund or the main fund. And then the syndicate can come in afterwards. The syndicates, the value of the syndicates is I have 5,000 people in that syndicate, and they are, my God, they are like experts in everything because there's 5,000 of them, right? And so, like, if I'm doing a deal in fire, there's this great deal that I looked at. The company basically had created this spray on cellulose product. So basically, food starch, and you spray it out of a sprayer. You can spray it onto like dry grass, and then they wouldn't start on fire. So literally, you could take a blowtorch and you could light up and they wouldn't start on fire because the cellulose actually had this like water gel stuff in it that would suppress the fire. So basically spray on fire suppressant. So here in California, where we have all these fires, I was like, oh, that's a good idea. We need that. But I'm not an expert in that stuff, like by any stretch. So it was like one of those things where like, that's a great idea, but I'm not an expert. So I reached out to my syndicate. I was like, hey, who knows about this? 5,000 people. Somebody's got to know about this. Whoa, we had like firefighters who chimed in. We had chemists who chimed in. We had all these amazing people basically came to help figure out this deal, like in very short order. And I was like, whoa, that's really cool. And that's like a superpower. Like I'm like,
did you invest eventually?
So there's a big company called FastCheck. They sell billions of dollars of the fire suppressant that's out there. They showed up and bought the company before we could get the deal done. I didn't get the deal done, but it was cool. And the power of the syndicate is like so good. So I basically think of it, I have the best of both worlds. I have a fund that can move rapidly. So like my fund, I can write a check tomorrow, whereas a syndicate takes weeks to put that all together. And I have this syndicate product that basically has all this great group of people, and so like I get the best of both worlds.
It sounds like you are the early adopter of AngelList, right? Based on your story.
I was. This is an example where I was an early adopter. Usually I'm not an early adopter, but in this case I was.
What about the rolling funds? Is also like a fairly new product.
Yeah, and the rolling fund is great for like basically like an LP will show up and they'll be like, "Hey, I want to invest with you," and I'm like, "Okay, well, I'll raise my next fund in 26, so you can come back then, or you can be in the rolling fund now and you get the same deals, same terms, same everything." And the great thing about the rolling fund is that every quarter you can decide to put in more money or leave or do whatever you want. And so like in 6 months, if you decide I'm an idiot, you can be like, I'm out of here. Whereas if you invest in the main fund, you're stuck for all the way. So the rolling fund is a great tool. Yeah, I love it.
But in rolling fund, you only participate in that quarter deals. Right? It's kind of you miss out on other deals.
Yeah, each quarter you put in capital, and then any deals I do that quarter, you are involved with. And then you get up to 8 quarters of cross collateralization. So let's say you do 8 quarters of investments. That's sort of like your fund. So all the investments that are in those 8 quarters become your vehicle of cross collateralization.
Do you see competition between your fund and rolling fund on deals?
No. They so basically what it works is that the two funds, they invest in parallel in any deal I do. So like if I do a deal, the rolling fund, depending on how much capital is in the rolling fund, because it moves up and down depending. Like when it was like back when we were all geniuses, it was much larger and now it's smaller. Depending on how much capital is in the rolling fund and and the right size for the main fund, they basically will take an allocation, and then that becomes kind of my main investment in a company.
And in your deck, we had a bit of a look at your deck before. You mentioned that you prefer market risk over technical risk. Can you just explain that a little bit to firstly myself and also viewers who may not be familiar with those terms?
Yeah, sure. So technical risk is somebody invents a new solar panel that you can put in space that is 5 times more efficient and 3 times lighter than a traditional solar panel. And the question is, can they manufacture that at scale? The technical problem there is non-trivial, and I'm not an expert in manufacturing solar panels for space. And so, like, some people could evaluate that technical question and they could say, yes, this is possible. Based on their expertise and their ability to bring in other experts, they could figure out the technical permutations of that problem and they could underwrite that and then say, okay, we believe this is possible and we believe the demand will be X, and then we will invest in this. Market risk is, okay, we are manufacturing this, we know how to manufacture this, but we don't know if anyone's going to buy it. That I can figure that's then a question of like, yeah, I can figure that out because I can go talk to the customers and say, oh, would you buy this? Why would you buy it? Why is it important? And I look for basically that product market fit crystallization of value occurs here. Because when I go to my friends, I send them a bunch of emails. So like I see a company and it's interesting, and I email my friends about it. I'm like, hey, what do you think about this? I can tell how fast they respond and how enthusiastically they respond and how enthusiastic they are about learning more from me. Tell how interested they are in that. What I'm looking for is like, I see a company, I like it. I email my friends about it. And then my friends are like, oh my God, I want that. Intro me to my company tomorrow. And by the way, I'm standing outside your front door. Get to work on this. I need this done. Like that's what you're looking for. There's a great example of this. Michael Seibel, who's one of the like sort of like YC sort of heads of YC. He has an analogy here, which I love, which is that you want your customer's hair to literally be on fire. So burning, like a freaking fire in your hair. And look, that bad. And your product is a brick. And you're like, I'm selling you this brick for $20 to put the fire out in your hair. Now, brick is not the right tool to put out a fire, but when your hair's on fire, you'll do fucking anything, and it's better than your hands. So, like, you're like, okay, here, give me the fucking brick. And so you can have a product that's not great, but the problem is so bad that they want it. That's what you want. You want that. You want the pain to be so acute that they just desperately want it. So, like that fire company, the Fosjet company, like I called up a bunch of people in the fire business. I was like, hey, this is what this thing does. And they're like, oh my God, introduce me tomorrow. I want that. Like, that's what you want. And it's tricky to find that. That's hard. It's really hard to find that. But that's what I look for. That's the secret.
How do you recommend international startups to navigate Silicon Valley these days? Right, it's kind of you mentioned that you do invest and then you help them, but let's say a startup just chooses to go to Silicon Valley. What do you recommend to do?
So the one thing I would say is that like the level of competition amongst the startups here is so high. They're pushing each other to like the cutting edge of what is happening here is not like what you read about on the internet. The cutting edge of what is happening here is literally what is being developed in the foundational model labs. Last week, they come up with a new feature and they call up their friends to try out the new feature. And then 6 months from now, it might be launched. But like, I'll give you an example. One of my companies is a company called Fireflies, the AI note taking tool. And the secret for Fireflies is that like they were friends. That Khosla is an investor in Fireflies, and Khosla is an investor in OpenAI. And so when OpenAI first started basically developing their technology, they called up the Fireflies guys and they said, "Hey, can you try this out?" So the Fireflies guys, because they're here in the Valley, that because they would be able to go to the office and hang out with the OpenAI guy, the engineers, they were able to iterate and test. They got invited in early. And so they got access to the technology before anyone else did. And so then their stuff started working way better because they got access to the technology. That happens across Silicon Valley all day long, every day, with all these amazing technologies. And so if you're a startup here, you get access to that if you're in the loop and you provide value and you're smart and you're in the game. And if you're not here, you're 6 months behind. And when AI came out, before, everyone was kind of working on the same technologies in SaaS and in mobile. Everyone had seen the stuff, the technologies had not really changed dramatically for many years. And so the startups in Europe and the startups in Asia and the startups in other parts of the world, they were using the same tools, and there wasn't a big delta between like the cutting edge of Silicon Valley and the cutting edge of anywhere else in the world. And so you could build a company that was just as good anywhere. Once AI happened, now the amazing stuff isn't announced, it's not released, and you need to literally be playing poker with the engineer at OpenAI to know about it. That means proximity matters. And so now the competition between the startups in Silicon Valley to get access to those technologies, to deploy those technologies, to use those technologies is so acute. They're all pushing each other, and the OpenAI engineers and the Claude engineers are all pushing each other. And so it's creating this maelstrom, this compression of pressure to go faster. And if you're not here, you're not in the game. And so
So you see a lot of migration these days to Silicon Valley? Yeah.
What I recommend to every entrepreneur that is in other parts of the world, you need to come visit. You need to see it for yourself. You decide if I'm right or not. You can go to the parties, meet people, talk to people, and make up your own mind. But like I suspect, like the Sintra guys, here all the time. Like if you're using AI, if your technology is in AI, then you need to spend a lot of time here.
Maybe we should organize a trip, Yuri, over there.
I lived there more than 10 years, but it's been a while.
I think the thing is that like for a long time, it wasn't that different.
Yeah.
Like the technology was I mean, it wasn't changing that rapidly. The thing is that like now there are secrets again. There was no secrets for years. Like there was nothing from a technology. Now there's secrets. Now there's stuff that's in some little corner somewhere that nobody knows about that like can change the world. And if you get access to the secret, you win. And if you don't, you don't. And so like now proximity matters. Now you got to get to those secrets.
It's kind of funny, like proximity matters now more than it did, like you say, a few years ago. You would kind of expect the opposite with everyone working from home and all that kind of thing.
Yeah, no, I mean, I made a big bet that the distribution of technology and knowledge and tools used to be secrets. So like when I first moved to Silicon Valley, there was no YouTube videos about how to build a startup. There wasn't barely any books. There was like you just kind of had to go to these parties and meet these people and ask a lot of questions and like just dig your way in. Like VCs was a secret thing. Like you couldn't even get a meeting. Like it was like all about proximity. And then the internet distributed that around the world. So now smart founders all over the world can build great stuff, no problem. And they can get access to all that information and the technology, and they can use AWS. And I was like, oh, it's going to globally distribute. And then AI brought it all back again.
So with regarding AI, like what is your perspective on AI regulation and ethical stuff? What's happening in Silicon Valley? Is it going to destroy us soon, or?
So I don't know. There's people who are much smarter than I am in terms of like where the technology is and where it will go, and they're deeper into the secrets than I am. They know a lot more than I do about where it could go and where it will go. And so I'm not the best person to ask about how to underwrite it. Will it destroy us or not? It's certainly possible. It's not zero. It's certainly possible. When it comes to the regulation argument, on the other hand, you can't regulate AI because you will fail. Like you can, they will. But it's stupid. So if you're in Europe, for instance, and you're like, hey, we're going to regulate AI, what's going to happen? Nobody's going to do AI in Europe. They're going to do it other places. And if the United States is like, oh, we're going to regulate you AI, because the technology is so powerful, then somebody is going to move to some country, Colombia, and they're going to do it in Colombia. And then you're in the US, you're like, you can't do that. And the Colombians are like, we don't care. We're going to make your cocaine and we're going to make your AI. And they're going to make all the money. And then the thing is, the technology can go anywhere, so you can't really constrain it. You can't stop it. You don't know what's happening behind. It's not, no regulation is just simply not going to work because of the nature of the way that you can develop it anywhere in the world. And so people are going to try, because lawmakers they're ignorant and they're stupid, and they're going to do it, and then they're going to fail.
Do you think there'll ever be a time? Well, I don't say ever, but like AI, like in zero-sum games. So, for example, financial trading or auctioning for ads, zero-sum games where there's going to be one winner. Do you think AIs will battle against each other for those?
They already are, right? Like Renaissance Technologies, which is like probably the most successful hedge fund of all time. Like, as far as anyone knows, they basically developed AI many, many, many years ago, and then they just didn't share it with anybody. So, yeah, no, absolutely. People are gonna develop super powerful AIs to do powerful things, and they're gonna fight with each other. That's what it's gonna do. I mean, I think there's no question about it.
So you already invested in one robotics company driving cars, right? Did you invest in more of robotics, like automation? No.
I'm not an expert in robotics. I invested in Cruise because I knew Kyle, and so he's great. He's like, I think we got this, and I was like, I don't know anything about this market, but I believe in you. So I invest in people who I've known for a long time, and like Kyle was an easy one. I tried to hire Kyle for many, many years when he was at Justin TV, and he was smart enough to say no. And so when the time came to invest in him here, I was like, no problem, I'll do it all day long. Yeah, but unfortunately, I don't have many people like that in my life. And like, for instance, his latest round, the new robot company he started, I mean, they raised at like some insane valuation, and they raised a shitload of money, and like it was just like beyond my fund's potential. So like, unfortunately, I don't have a lot of Kyles. Even though I know a lot of people, there's just not that many Kyles in the world. So, and the good ones get scooped up, and so it's a challenge.
Do you see yourself, growing your fund further, or you're good with the solo GP model?
I haven't decided yet. I might actually go the other direction. Like it does so well, it performs so well. Like right now, I get to keep 20% of the gains. I might just use my own money and keep 100% of the gains. And then it's easier because I don't have to deploy as much capital, and like it just I haven't decided. I'll probably raise one more fund, but the thing is that like the bigger the fund is, the more competition you have with these big firms, and these big firms are building all this infrastructure that's very expensive and time consuming, that's compressing their returns. So the competition and the cost basis to compete means that you end up with like pretty low performing funds, and then their belief is that one of them will get scale, and then that will enable them to be the winner at scale, but like the performance gets compressed. Whereas when you're down where I sit, like like my 2017 fund is like a 15x fund right now, and it will probably end up being double that. It'll probably be 30 plus. Like, I tell people I hope it can get to 100, but I don't know if it's going to get to 100. But I think it'll get.
It's crazy performance for sure. Yeah,
it's great, right? But like that's because I'm small, and I'm writing small checks early, and I can take a lot of risk, and I don't have all the compression that comes from competing against other big funds and all the things that are there. And so like that, there's still a lot of alpha where I sit in the market. And so I like that. That's good.
So there are more and more of solo GPs, right? Kind of graduates of VC Lab, lots of solo GPs. How do you recommend solo GPs to operate? Because it becomes like a lonely job in a way, right?
You have to have a personality that likes it. Like, I like the freedom. I like the fact that, like when I have an investment committee decision, it's me arguing with me. Uh, like that's good for me. The way I look at it is, if you look back at all of the money that's ever been made in venture, so historically, it all gets made by doing non-consensus, contrarian, weird stuff. At the time, Airbnb was weird. Like Uber, when it first came out, a lot of us, including me, was like, "This shit ain't gonna work because the taxi lobby is gonna crush you." Like almost all these big ideas, when they first happen, are not. There's something strange about it. And when you have a committee, committees basically block strange. They don't do well with strange. Strange is hard to get through a committee. And so, like, you have this whole infrastructure, this whole venture infrastructure that is built around committee decision making in order to find weird stuff. Like, those two things don't make any sense. The reason why the venture ecosystem is built around committees is that 20 years ago, it took a lot more capital. So you had to go to big institutions. The big institutions were like, well, look, we only want to, we need to invest at least $20 million, and we don't want to own more than 5%, 20% of your fund. So you need to have a big fund. Big funds means you got to have a lot of people to deploy the capital. A lot of people to deploy the capital means you got to watch each other because you don't know who's an idiot or not. And so all these guys get together in a room and they watch each other to see who's smart or not. And now you have a committee. And the committee makes bad decisions in general when it comes to finding weird, contrarian, non-consensus stuff. So the whole infrastructure of venture is built around the wrong model. Whereas if you go to other risk assets, when you have a risk asset that is about finding the weird stuff, it's always 1 p.m. 1 p.m. in the hedge fund world is the model. It's not like, let's go freaking have a committee to make decisions. And so, like, I think the venture solo founder model is a better model. Now, there's downsides to it. There's all sorts of things that are not great about it. But at the end of the day, if the goal is to find weird stuff, that's where the alpha is. The solo GP model is better at that. And so now the LPs, they're slow moving. They're very slow moving. They have to adopt to that. It's going to take them time. But the end stable equilibrium configuration is you have a large number of solo GPs. Some of them will get hit by a bus. Some of them will outperform. Some will underperform. But the outperformance is where you make all your money, and that will basically give you much better return than investing in a bunch of committee decision making.
So, from standpoint of LPs, you recommend to look for the solo GPs and invest in portfolio of solo GPs.
I think that if you were an LP and you built a solo GP portfolio, a large distributed solo GP portfolio, you will massively outperform for 3 reasons. One, I just said, because 2, all the money in venture gets made by basically the head. If you're in Sequoia or you're in Benchmark or you're in Name Your Best VC fund, great. You're not going to leave that. That's a special thing, but it's really hard to get into that. Most people not only don't have access to that, they're never going to have access to that because it's like you had to get in there 20 years ago. Whereas the solos are young and they're just getting started. And so you can get access to great capital deployers before the rest of the market realizes it, before it's impossible to get in. So the new model means new participants, means new access, which means you can maybe get lucky and get into somebody who ends up being in the power law returners that you're never going to get in the future. And the third one is that there's real alpha in solos. So if you go talk to 100 solos, you're going to get a wide dispersion of personality types and tactics and strategies, and they're going to be, and you can go in there and identify the ones that you like that fit what's right for you as an LP, and you can build a really idiosyncratic portfolio. Your alpha as an LP can be expressed, whereas venture funds, they all look the same because they've been doing the same thing for a long time. They've all been compressed into this like very similar model, very similar marketing, very similar message, very similar behavior, and I argue very similar returns, because they're all kind of doing the same thing. And so you don't get a lot of alpha in a venture fund.
These are great insights. And what do you do for fun?
I do a lot of kite surfing in the winter or in the summer, kite surfing and wing foiling, and then a lot of skiing in the winter. And then I have a new thing that I've been doing now where I'm getting serious about trap shooting.
What is that?
Shooting targets. So basically, you throw a clay target into the air, a shotgun.
Nice.
Yeah, it's been fun. Fun thing. It's my new thing to get serious about.
Amazing. Great. Thank you for joining us today and sharing these insights. We look forward to see you in Lisbon again, but maybe we'll meet you in some of our events around the world during the year.
I hope so. Good to see you guys. Enjoy the rest of your day.
Yeah, thank you.
Thank you.
Thank you, Nico.